Welcome to TheoTrade. This is Don Kaufman. It's March 2nd, 2020, and you are watching the TheoTrade evening video. There are just minutes left inside of today's trading session. Well, finally, we see that quintessential rip your face off rally. We're looking right now at a 4 and almost a 0.5% move to the upside inside of the S&Ps. Of course, at this point in time, this is where people, of course, they come out of the woodwork and that's it. Sound the all clear. Buy the dip is back in play. I caution you right now. Okay, that's the question over here. Should you come in and buy this dip? And I'm going to warn you right now, right up front, make it crystal clear. Look at the range. I'm just going to freeze the screen. Again, while we're squeezing higher, just got to freeze the screen. Look at the range, okay, from high to low in today's trading session. You don't have to question any more than this, okay? That's a 200-point move inside of the S&Ps. You think volatility is gone? Okay, this is actually one of the hallmarks, okay, of the extreme, is the explosive move back to the upside. And if anything, this should make you a little bit more worried as an investor, as a trader. Because yes, there is substantial volatility yet to come in this marketplace. Let's get down to business and let's actually show you specifically, okay, what I see and what you should know moving forward. First and foremost, let's get this out of the way. So the S&Ps are literally up 130 points. The NASDAQ is going to have a 400-point up move today. But one of the things I like to do in this is we're going to actually pop to a 30-day 1 hour. And I'm doing this just to give you a little bit of perspective of some of the damage that was done. Obviously, we were trading, roughly speaking, 3,400. We have a wild slide to the downside, okay, taking us all the way down to, let's just call it 2,850 and a bounce back up. Here we are closer to 3,100. Nevertheless, we are still, okay, about 300 S&P handles shy of where we were, okay, just over a week ago. All right, so again, this really does kind of meet some of the criteria. It checks a few of the boxes, as I always say, for that kind of quintessential rip your face off rally. And people ask all the time, like, what does that even mean? Well, you don't have to look any further than the S&Ps in the last couple of moments, which have actually traded roughly from our gravity point. Gravity point was 29.83 and exploded. That's 100 handle move directly to the upside with, again, minutes in here that are 10 and 15 point minutes inside of those S&Ps. So again, this should be a little bit of a warning shot being fired across the bow when you think about, I'm going to buy the dip, okay? Is this a buy the dip, or is just this that quick reaction that you had tons of traders, including myself, all right, that were in heavy short positions for considerable periods of time. And when you're in a heavy short position for a considerable period of time, and the market obviously comes down substantially, sooner or later you have to buy back those positions, okay, to exit them, and we get these huge, again, what we call kind of that rip your face off rally. But that's not going far enough in analysis of some of the moves specifically that we've seen today. Here is some of the more bothersome areas, and we're coming in. There's the closing bell. One of the more bothersome areas of some of the price action that we're seeing here, and again, that's really what I want to elaborate on and not necessarily, disarm you to go out there and buy the dip, but I'm telling you that it is far too early to sound an all clear. All right, we could point out the VIX. Right, so if you take a quick glance at the VIX, the VIX is down some 21%. That's all fine and dandy, but take a look where the VIX happens to be. You realize the volatility index is still at one of its highest levels, okay, over the last 3 years. In fact, to see the VIX at these particular levels, I can even maximize this. I'll even maximize it here to the extent of the entire VIX chart all the way back to the inception of the VIX, and we closed the VIX at about 32 today. So let's draw a line across the screen just for you briefly. Quick line across the screen. So you can see not only are we in an elevated VIX stance, we are in a VIX stance, okay, that should of course be alarming. So volatility is still, okay, really, it's come off a little bit, not enough. Now, as you guys may or may not know, I don't follow the VIX all that much because I think it's kind of my predecessor's indicator of volatility. More often, I look at the volatility futures, and I am very bothered by what I see inside of these volatility futures. So, just put this again in perspective. For those of you that have looked at volatility futures, we just saw almost a 5% move up inside of the S&Ps. We did basically see a 5% move up inside of the NASDAQ and actually saw over a 5% move up in the Dow. And the volatility futures laughed and backed off a whopping 44 cents. Okay? You have to look at that and think to yourself, I don't really get it. Neither do I. The volatility hasn't really backed off. For the most part, okay, we look at this as nothing more than price action to the upside, but volatility isn't subsiding. In fact, if you start to look at this a little bit more detailed, and I like to look at the volatility futures amongst themselves, talk amongst yourselves, but if you take a look at the 44-day volatility futures, okay, look how much volume they have out there. That's big boy volume. Did you know that they ended up on the day? They actually ended up in the day, okay, and there's still a vast difference between the April volatility futures and the May volatility futures. We're still completely inverted over here, which makes the overall marketplace Mr. Toad's wild ride. And we are absolutely still just that. Again, the volatility futures, you are looking at this correctly, finished higher in today's trading session. And those are the volatility futures that matter right now with a 130-point move to the upside. Scroll to the bottom of the screen over here. Take a quick glance at the VVIX. That's the volatility of the volatility index. Now, the volatility did come down to the volatility index, but to 114, I don't know about you, okay, but that still looks like some very painful territory. Now, a few sectors that are in play. A few sectors, a few individual stocks. The airlines, okay? Airlines are actually still taking a hit. This is not surprising, okay, by any stretch of the imagination. You've actually got American Airlines still down effectively about 1% on the trading session. Go take a quick glance at United Airlines, also down about 0.5%. If you take a quick glance also at XOP, and I've actually built positions in XOP, it'll end up massively unchanged. This is the oil and the gas ETF, massively unchanged on the trading day. So what I'm getting at over here is there are some weaker areas. What are some of the stronger kind of areas in the day? You have to look at things like consumer staples. Consumer staples, they exploded 5.3% to the upside. So the consumer staples had, again, an astounding rally, getting back, if you will, almost half of what they lost in recent trade. In fact, looking at this year-to-date percentage, just the other day, what are they? They're up almost 4% of the year. They were down 10%. Now they're only down 2%. People, this is volatility. This is volatility in here. Okay, the other one we want to look at is, of course, utilities. Now, it wouldn't surprise me to see people run into utilities for all the wrong reasons, though, because we heard from some of the central banks inside of today's trade, which I'm going to come to here momentarily. Nevertheless, XLU, also one of the strongest, almost a 6% move up in the utilities. And I'm telling you, this is what you should expect, okay, when seeing volatility. Now, a 200-point range, including overnight trade, unprecedented. Nevertheless, the SPX had a 136-point move on the trading session. And again, I just want to put this into perspective before I actually go a little bit deeper into some of the central banks. Okay, take a look at the expected move in the week. Now, for those of you that tuned into the weekend video, the expected move, okay, was effectively, and you thought this was like total and complete chaos over here, but that expected move was plus or minus, okay, roughly $182. To see a $136 move up today is pretty much par for the course. You should see that kind of move. And because this expected move is so substantial, okay, for the entire week, you know, people talk about dealer gamma and, you know, there's negative gamma and positive gamma. People throw it all off the table. When you have an expected move that's this large, okay, that is total and complete free-for-all territory, because these trading firms, whether they bought options or sold options, which that's what makes you long gamma or negative gamma, right? Whether you're long gamma or short gamma, doesn't matter, okay? What you have to know is this is just a hell of a lot of room for movement, okay, in either direction, which creates a whole lot of chaos in the week. But tuning in specifically, okay, to the SPX, and if you look at the SPX between now, okay, and when it expires, 4 days from now, there's still $115 of movement packed in. Fun for the whole family in there. Again, this is not the time to go out there and to run out and try to buy the dip in terms of an investor. If you wanted to go out there and tell me that you're going to use a couple of defined risk strategies, I don't care whether you're bullish or whether you're bearish, but I am going to tell you here momentarily, if there's some follow through to the upside in the next, day of trade, I think we're actually going to get a very, shortable opportunity, which is what we call a fade. All right, what we're actually going to be looking for in the very near term. In this bounce, we're going to look if this thing takes off, it ignites a bit more to the upside for it to roll back over and some of the volatility start hitting us again. Wouldn't surprise me again to see some follow through though to the upside. Let's come, to the most pivotal sector right now of all the sectors. And no, it's not. It is not going to be the monsters of tech. It's all about the financials. This morning, the financials, were teetering back and forth on the most pivotal level, which is 2650. They actually hit that 2650. They crossed under it. The entire marketplace looked like it was going to tank. Then we turn and we burn to the upside on the trading session. In the days to come, to get a better feel, right, and to get like stability, if you will, in this marketplace, stop looking at all the different sectors. Only need to look at one. If the financials come off, we're coming off big. Bottom line, the 2650 level, if we actually hit the 2650 level, anything under it is dire for the broader S&Ps. That is, S&Ps are going to continue to see heavy sell side activity. The reason, for some of the concern, of course, in the XLF, if you miss this, all right, you're missing a whole lot that went on. This is the TNX. This is the 10-year Treasury index. It's the interest rate. This is the interest rate associated with the 10-year. We are now officially, in, right, and closing in on full-on 1% territory. I suggest that before any of this is over, that we're actually going to cross into territory, with this 10-year at things like 0.88%, meaning that we're very likely to drop under that 1% level, specifically inside of that 10-year. Scary, right? Which actually brings me back over to the XLF. Falling interest rates, that doesn't even do it. Crashing interest rates, You think that's good for the financials? Absolutely not. The financials right now are just a knee-jerk reaction back to the upside. And here, people, is where volatility lives. Take a look at the financials even 4 days out. There's still a 50% IV with a $1.26 move. It just moved $1.36 today. These are astounding size moves. Now, the reason, again, I'm so critical of these financials, I want you to recognize the Bank of Japan. Well, they came out last night. In fact, take a look back over at the S&Ps, and I'm going to zoom in all the way, to 1-minute charts. So last night, Bank of Japan comes out, and what do? They're going to offer stimulus. So when the marketplace opened, all right, on Sunday, it dropped, and it dropped substantially. Bank of Japan comes out, they offer stimulus, the market ignites to the upside. That's not enough. The marketplace started fading back this morning. So this is after the Bank of Japan. The marketplace fades back this morning. This morning, right before the cash open, then who comes out? Oh yeah, there's more. It's a coordinated effort. Now we have the ECB. This is the European Central Bank. Right in this territory here, takes us right back up to the 29.83 gravity point. We start to fade back over here. They continue commentary. We explode back to the upside. All right, there's a coordinated effort from the central banks, which is making us that much more dangerous at this point. Why? If we start to see some sell-side activity, in the days to come, which is very, very likely, I believe the central bank, of all central banks, our Fed, is going to step in. If we sell into, the Fed commentary, then we have severe problems. That's what we call turning the back on the Fed. And this marketplace has done it in numerous times, in recent years. But to fully turn your back on a Fed cut, imagine if the Fed came out and they cut. That hasn't actually happened since the financial crisis, going back to January, if you will, of 2008, and then later when Ben Bernanke cut in September of 2008. Remember, the marketplace fell in both of those instances where emergency interest rate cuts were enacted. At this point, strictly my opinion, we are on nothing more than a bounce. We are on borrowed time, and I'm actually going to be looking to fade this particular move. More importantly, if we do actually hear from the Fed and we get that knee-jerk reaction that we explode back to the upside, I'll actually be shorting into, if you would, an emergency interest rate cut. Thanks everybody for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.